Good afternoon, everybody, and welcome to this discussion with Walton Land Investments. I am joined today by Tim Haywood, who is Managing Director of Walton for the Middle East region. And Walton is actually one of the partner companies, investment companies that we've worked with for actually many years now, a very, very long time. Probably as long as I can remember, really, in the investment space in not just in the Middle East, but around the world. And it's a really interesting topic, I think, because especially at the moment when has been a much heightened level of volatility in the traditional investment markets, generally the stock market. For many, many years, the volatility in the stock market was very low because we just had this sort of steady sort of uptick in the S&P 500, and that has been shattered in recent weeks and months as the volatility has come screaming back. And a lot of people, maybe particularly people closer to retirement, who are wanting something more steady and something more assured, something a bit more sort of predictable, perhaps, I've really started questioning, well, if I'm not in the stock market because I don't want to see my money swinging, up and down 6-7% a day, where else can I be? And I think Walton really kind of answers that question with a very interesting offering, which is very predictable, got a very long track record, very steady, and I think ticks the box for a lot of people in relation to something a little bit different and a little bit more steady and predictable. So thanks for joining us, Tim. I'm going to hand over to you, and if you could introduce yourself and Walton for people who haven't come across you before.
Will do. Thank you, Vin, and great to be here. So I'm just going to share my screen here for you. If you just bear with me 1 second. I think that's come up okay now.
I think we're in.
Brilliant. Okay. So yeah, thanks for the introduction, Vinny, and great to be on the call with you tonight. As Vinny said, my name's Tim Haywood, Managing Director of Walton here in the Middle East. And in fact, I've actually been with Walton now for 18 years. And as Vinny said, we've worked together for a long time. Really, Walton is a specialist US land asset management company. And I think what we bring to the table is something somewhat unique, but it's something that's tried and tested. And Walton as a company has actually been in business now for 46 years. So what I was going to do is take you through a short slide deck, which will give you a good understanding of who we are, what we do, and perhaps pick up on some interesting elements that are going on right now and are pretty relevant and hot topics for all of us, particularly given what's happening in the US.
I feel like it's the right time for this conversation, Tim. I think we've timed this pretty well. It's very topical, I think, now.
It is, and it's changing by the day. So, of course, I think most people are pretty glued onto the news right now because literally every day there is something quite different, depending on which way the wind is blowing and how, I guess, Donald Trump feels in the morning and the response he's seeing from the various policies he's putting in place.
That's right.
So Walton ourselves, as I say, we're a US land asset management company. We were founded in Canada back in 1979. We focused on the research and acquisition of land in Canada for many years, but we actually moved down into the US in 2008. And as the old expression goes, when there's blood on the streets, Walton went into the US, of course, on the back of the subprime crisis and the 2008 global financial crisis. We have around 4.5 billion of assets under administration, some just under 88,000 investors globally. And what's very important these days, of course, is getting money back to investors. And to date, we've distributed around $2.67 billion back to our clients around the world. And that is, not without peaks and troughs along the way. And as you would imagine, over 46 years, we've seen it all. In terms of land assets, we administer around 89,000 acres across the US. And again, as you would expect, a company that's been around for as long as us, We've also exited some 45,000 acres, which we've actually gone full cycle. We've sold off to home builders and developers, and that's across some 312 properties. So, we've been there, we've done it, we've got the t-shirt, we've broken the mug, as they say, and we've kind of been through multiple cycles in North America. Where Walton really fits is again in the land space, and I think it's worth just pausing for a moment, and without wishing to teach clients to suck eggs here, what we do need to just perhaps visit is where land sits within the real estate life cycle. And of course, most clients will be involved and invest in bricks and mortar, stage 4 of the real estate life cycle, which is the most liquid and probably most competitive end of the spectrum. Most of us, in fact, we all participate in developed real estate, whether we rent, we own, we are taking office space in commercial premises, whatever it might be. Everybody is involved in one way, shape, or form. But as you move backwards through this real estate life cycle, it becomes much less competitive and, of course, much less liquid. And so when you move into the home building space, of course, there are specialist home builders out there who we deal with, many of them who are doing all the vertical construction. When you move back into the horizontal development, which is creating the development lots, putting the infrastructure in the ground, there are even less specialists operating. And of course, again, the capital requirements to get involved in the horizontal development are quite significant. And when you get down into the land space, of course, there are even less specialists, and it's the most illiquid end of the spectrum. And what Walton likes to think is that over the years, we've brought liquidity and efficiency to the land space, because traditionally it is, as I say, pretty illiquid and pretty inefficient. But of course, you have to start somewhere, and identifying land in the path of growth which is suitable for large-scale, cost-effective residential development is really one of the niche aspects that Walton brings to the table. So as you go through that real estate life cycle, of course, you're moving through the various stages to going vertical, of course, then to that fully developed out community. And it's really what Walton specializes in doing in that land space. In terms of our land assets, we are across the US, but very much in a focus area in the Sunbelt states of the United States. And the reason for that is really because they demonstrate the major fundamentals that we look for. And what those fundamentals are is very simply jobs, people, and permits. Continued sustained population growth, the creation of jobs where people are moving to, and of course then they need shelter. And so what you see is our focus is very much in the Sunbelt states of the US, which demonstrate those major fundamentals. And of course, it's no great surprise that when we look at where the home builders are most active, they also are in those Sunbelt states. And of course, it's not just about where people are living right now, it's where people are moving to. And so when you look at the affordability factor in the US, why people are moving from the likes of California or the East Coast, and they're moving into places such as Florida or Texas or Colorado, really it's because jobs are being created. There is potentially a lower cost of living in those markets and a more affordable housing product. And so when you combine all of those factors, you end up with a net domestic migration effect of people moving across the US and within the US to seek out better quality of life, more affordable homes, and of course, potentially a better paying job and lower state taxes. So all of those factors come into play. And as you can see, we've got about 80,000 acres across the US, balance in Canada, and very much focused in those Sunbelt states within the United States. So the value that Walton brings really into the mix is really to feed land into the major public home builders across the US. And I think it's really quite important to understand that aside from all of the noise and the headlines that we see of what's going on in the US right now, fundamentally speaking, there is a housing shortage in the US. The general consensus is somewhere between 2 to 4 to even 6 million home shortage in the US, and that's not going away anytime soon. And as a specialist land banker, if you want to refer to us as such, what we really do is we are feeding land into those major home builders, the top publicly traded home builders in the US, to really allow them to get on with what they do best, which is, of course, build homes. And what we see in the home building space is home builders really want to adopt and have adopted over the years what's termed as a land-light strategy. And that is where they just hold enough land on their balance sheet to meet their short-term development needs, but anything much longer than about 24 months, they really want to see that off their balance sheet until they're ready to start developing it. And so Walton really fills that niche gap by allowing or holding land for those home builders and feeding it to them as they need it, as they need to take it down to start their development. And one of the benefits that we bring to the table to those home builders is that we are, a scalable offering. And what I mean by that is we offer a national program. So we can go into the biggest home builders in the US and we can effectively open our menu and say, well, we've got assets stretching from Southern California up into Colorado, down into Arizona, across Texas, into Florida, through the Carolinas, Tennessee, and into the DC region. And that really helps us to meet the requirements that these home builders have. And on the back of that, we've been able to forge some very, very strong relationships with the largest home builders in the US, including, in fact, the largest, D.R. Horton, who is a very strong strategic client of ours. And I say client because we sell them land. So ultimately, they are buying a product from us. And that is part and parcel of what I'll talk about today in terms of some of our offerings. And as we feed that land into the home builders, we have actually transacted with 14 of the top publicly traded home builders in the US. And you can see here just really the scale that these home builders operate on. D.R. Horton and Lennar are the two largest home builders in the US. And you can see there they account for about 25% of all single family home closings. So 1 in every 4 homes is typically either a D.R. Horton or a Lennar home. But also what you can see there is, just the way there is a big drop off between positions 1 and 2, and then 3, 4, 5, 6, 7, 8, 9, 10, all the way down to 20. And it really just gives you an understanding of the scale on which D.R. Horton and Lennar operate on. 90,000 homes in terms of closings in 2023 for D.R. Horton, 73,000 for Lennar. But also take note of the margins that they're operating at. Those margins are pretty strong. And so when we talk about some of the challenges in the housing or in the US market in terms of housing, interest rates, supply side, home prices, one of the ways that these home builders can actually really help to keep home buyers coming through the door, as it were, is really by offering incentives. And so if that means they squeeze their margins a little bit more, then they can afford to do so, because at 23 and 22%, they've got very, very healthy margins indeed. And that really helps them, remain competitive in the market.
I was going to ask Tim, actually, there's in terms of the interest rate cycle in the US and how that affects property and land. Do you find that it's kind of better to have interest rates going up and that being a sort of healthier sign of an economy, or for the purposes of what you guys do, is it usually more attractive to have interest rates going down, which might infer a weaker economy but makes the cost of borrowing cheaper for the for the average homeowner? Which way do you guys sort of see it? Does that play into your strategy or the overall proposition?
Yeah, it's a really interesting question, Vinny, because of course one of the challenges we've seen over the last number of years since COVID is you've gone from interest rates at sub 3% up to knocking on the door of 8%, and that's happened very rapidly. So that interest rate environment has certainly been a challenge. We saw that as those interest rates hiked up, a lot of home builders just stepped back from the market because home buyers also stepped back and said, let's just wait and see. We need rates to come down a little bit and before it makes sense for us to go in. But I think the sweet spot in terms of interest rates is probably around that 5.5% mark. That I think is when, forgive the pun, but home buyers will get off the fence and kind of get back into the market. So where it sits right now at 6.5, whatever it is, percent, what you're seeing is the home builders are still having to put incentives in place, and they do that through mortgage rate buy downs, where they bulk buy the mortgages and then they offer discounted rates to the home buyers. Back down to about that 5.5% mark, because again, that is the sweet spot. So it's a little bit of everything really. And of course, the other aspect here is that because of that supply side shortage, it has of course pushed home prices up. And so if you combine that with a higher interest rate environment, something's got to give. And that's where having that interest rate dropping will be advantageous to those home buyers.
That's good to know, because it's most economists are now predicting one or maybe even two rate cuts in the US before the end of the year. So that's the chances of that are significantly greater. So that feeds in nicely, I guess.
Yeah, absolutely. And of course, the home builders, they don't want to keep on giving up their margin. So if they can see that rate drop and they're not having to put the same sort of incentives in place for buyers, and that could be anything from, as I say, the mortgage rate buy down, or it could be discounts on closing costs, and those kind of things, then of course they'll be happy as well.
Okay, great.
Now, I talked earlier about land-light strategies, and a lot of people may ask the question, well, what is that, and why do home builders want to keep land off their balance sheet for as long as possible? And the answer really is here. One, of course, it's much more capital efficient for them. It means they can deploy capital into other areas, and that might be acquisitions of smaller home builders who might be struggling in current market conditions. It may be that they can kickstart developments that much quicker because they're deploying capital into development rather than tied up in land, which is effectively sleeping. And of course, when it comes to risk management, just the overall view of how they're managing their balance sheet exposure, not carrying too much long-term land inventory on their balance sheet, because they certainly don't get any thanks from Wall Street for doing that. And so by keeping a more land-light strategy in place, they get rewarded through Wall Street. Obviously, it's reflected in their share price, and overall their risk management aspect comes into this as well. But also overall that sort of strategic planning, managing their short-term and medium-term land requirements and working with specialist land bankers such as Walton to really allow and help them manage that inventory and how they're going out to market. And of course, finally there you can see preserving cash. That really does allow them to use it for other purposes I've mentioned already. But by expanding their operations, by acquiring other home builders, and I think that's something we're going to see an awful lot more of over the next little while. It is again a consolidation in the market where the big home builders can really afford to ride out tariffs and uncertainty, and that they will absorb the smaller home builders who simply don't have the same economies of scale to ride out those kind of fluctuations and some of that shorter term volatility perhaps. So I think one of the questions is always, well, where to invest and what sort of asset classes should be considered. And some of the things we've seen, just recently, is irrespective of what's going on in the press and what's happening with the Trump effect. The US market is still looking pretty robust. US unemployment is pretty low, and when we compare that to the UK or the EU or Canada for that matter, who of course have just gone through their elections, it's still pretty competitive in terms of unemployment. So we hear an awful lot about cost of living, affordability, all of these things, but ultimately you've still got a pretty strong workforce there in the US, and this is going right up to March 2025. And of course, you've got sustained population growth. You've also got, the continued view of the US as, do you know what? America first, yes, but it's still a good place to deploy capital. And I think, what you see here on the screen is just some of the headlines, irrespective and regardless of Trump's, first 100 days. Nobody can argue that he's not putting America first, and that's ultimately good for America. But what you see here is a lot of inward investment into the US, despite the headlines. And so the likes of Johnson and Johnson, Apple, OpenAI and Oracle, SoftBank and the like, all looking at deploying capital into the US, whether it be at opening additional facilities, creating jobs. And of course, for our region here, we've seen the news over the last couple of months. The UAE pledges 1.4 trillion of US investment over the next decade. Trump is due to be coming over to the Middle East, I believe, in the next couple of weeks, and there is talk of pretty significant deals being signed with the Kingdom of Saudi Arabia. And of course, you've already seen that with the UAE as well, and who knows what else is going to be signed. But I think overall, there is still a view that the US is still pretty strong and is still ultimately the land of opportunity and where people want to be. And of course, with that, there is also a lot of discussion around the sort of traditional asset allocation. And one of the more recent pieces of news that has come out was from BlackRock, of course, the largest private equity firm in the world, about $11.5 trillion in assets, talking about that move away. And this is something we've heard previously, of course. That sort of traditional 60-40 stock bond allocation is perhaps a little archaic now anyway. But certainly there's been talk of more of a sort of a 50-30-20 model, particularly looking at 20% into private assets. And of course, that is really that sort of alt space, that alternative investment space, which is bringing perhaps more predictable returns, whether it be through fixed income, private equity, whatever it might be, is really kind of saying, there's a place for that in the portfolio. And I think, to your point, Vinny, as you opened with, it's about removing some of that volatility out of the portfolio and looking at alternatives. And we think we have a pretty good solution there.
Yeah, well, Warren Buffett himself has got his highest ever allocation into cash at the moment, and has done for the past sort of 9 months or so. So he's not often wrong, and he said he's quite happy sitting there collecting 4.5% in US Treasuries. So if Warren Buffett's not too bullish on the stock market, then perhaps other people might be thinking that they might want to diversify as well.
Yeah, absolutely. And this is, again, from others out there as well. JP Morgan, talking about value-added real estate as a top-performing private market strategy. US value-added real estate there sitting at the top. And this is, again, from their asset management division. This is as of September, a little bit out of date. But again, it just gives you that kind of another view of this. From the investment banking and private equity world. So interesting to see. And of course, we see more and more of that coming about as well. And of course, one of the things we talk about as well is, that resilience within the housing market, and again the way that the public home builders are managing themselves, managing their balance sheet. They've got that financial strength and scale. The likes of D.R. Horton, Lennar, the largest home builders in the US. It means not only can they ride out some of the tariff volatility, should we say, because their economies of scale allow them to basically lock in costs of lumber and white goods and various other bits and pieces, because of course they're doing it on a large enough scale that they can effectively lock in those efficiencies. But also, when you look at those more flexible strategies, things like putting incentives in place, things like the mortgage rate buy down, all of these are tools that the smaller builders simply cannot compete with, and so that does really become an advantageous position for these home builders. And as I've said already, that adoption of an asset-light model. And what you can see here is just over the last 6 years or so, on the right-hand side of your screen, the percentage of land and lots which are outright owned versus controlled through option contracts and option agreements. And it's gone from a kind of traditionally more of a sort of a 60-40 split to quite the opposite. And so that preference for option land and lots is very, very strong right now. And that's been going that way probably for about the last decade or so, I would say. And that's exactly what Walton plugs into. And I think it's always good just to provide some context, because of course, many people in this part of the world will not necessarily be aware of who D.R. Horton or Lennar or Polte Group or any of these others are. But if we just look at D.R. Horton alone, with some perhaps more household names, both here in the UAE and of course regionally, and of course for those from the UK who might be tuning in, some more familiar names there. But you can just see here the size and scale that D.R. Horton are operating at, not only in terms of market cap, but also just in terms of their overall revenues, and their investment grade rating. They're A- by Fitch, they're Baa1 rated by Moody's. So that counterparty risk of D.R. Horton is very, very strong. And in fact, it's reflected in the market as well. I've just seen, in fact, today, they've just issued a 5-year debt issuance, which is sitting at just under 5%. I forget the exact figure. It's about 4.85% maybe on 5-year debt. So that gives you an understanding of the way the market rates D.R. Horton as well. But when you compare that to the likes of EMAR, of course, who are very strong in terms of market cap for the size of the population here in this market, but also more perhaps household names out of the UK, the likes of Taylor Wimpey and Barratt, D.R. Horton really are a kind of a beast in their own right, and it's quite impressive to see.
Interestingly, that investment rating of A-, that's about as good as it gets for a bank as well. So effectively, you're saying that D.R. Horton are as good a credit proposition as any of the major banks. That I believe that's the highest rating any of the big banks have as well. So that's as good as it gets, really.
Yeah, it's pretty impressive. And when you look at them in terms of both their market cap, but also, I mean, they're sitting 120th on the Fortune 500 list. They are a sizable operation, and it's very interesting actually when you look at D.R. Horton's journey. Very similar kind of trajectory in terms of when they were founded. Sort of started by an individual, Don Horton, and the stories of him literally just going to the banks and wanting to get a loan just to start his first development. We started back 46 years ago with a 15-acre site up in Calgary, and it's quite interesting to see those there's a lot of similarities, albeit that D.R. Horton are a much bigger beast these days than we are, but the way that we feed land into them is quite telling. So again, diversifying your portfolio, US real estate backed investments. I think it's quite interesting, again, just to kind of bring it back a little bit and really look at Walton's sort of product lines. We have three core products ultimately, which are all US land asset backed. We have a Walton Land Investment Strategy, which is very much focused on growth and income. It provides a direct ownership structure with title deed, targeting a 12 to 15% per annum IRR return over a sort of a 3 to 7 year duration. We then have a Builder Land Finance Strategy, which I'm going to talk about a little bit more in a second. And that is an exclusive arrangement that we have with D.R. Horton. That's why I've spent a little bit of time talking about them today. And that really forms a core strategy of both our fund offerings and our Walton Land Finance Strategy, which is what I'm going to be talking about mostly going forward. And of course, our Walton Land Finance Strategy at the bottom there is actually a hybrid model of the two previous strategies. So it comprises both Walton Land Investment and the Builder Land Finance Strategy, but is a fixed income offering. It provides a fixed income return of 8% per annum, which is paid quarterly, and it's structured over a 5-year term. And one of the beauties of it is that it's not subject to US tax. It benefits from a portfolio interest exemption, and that means that there is no withholding and there is no tax due as that comes out of the US. So again, it provides quite an attractive sort of coupon-based income payment there. So with that, I'm going to focus on Walton Land Finance, which, as I say, is our fixed income model. It is a 5-year duration. It's actually a 3-year maturity with 2 1-year extensions, which I'll go into a little bit more in a minute. It's an interest rate at 8% per annum, simple interest paid quarterly, with 2 additional 1-year extensions and a 25 basis point increase in the interest rate for each year of extension. The security of the loan structure is that it's through a wholly owned subsidiary of 66 Knightsbridge Holdings, which is the parent company of the Walton Group of companies. This is for non-US persons only. For any US nationals, we do have a US appropriate product, which is our growth and income strategy that is available for US expatriates. As I mentioned, this fixed income strategy qualifies for the portfolio interest exemption, which means that it's tax-free coming out. And of course, that security is truly asset backed, 100% backed with an equity pledge, a legal equity pledge of the assets held within the Walton Land Finance entity. So here are the key terms. As I say, it is a direct open loan structure. The borrower is Walton Land Finance LLC entity. Each entity is ring-fenced at $15 million. We are currently on Series 11. Series 1 to 8 were $10 million caps, but going forward, we're at $15 million caps. And that will be allocated on a 60-40 basis between Builder Land Finance and our direct land investment model, which I'll talk about in just a second. The terms I've mentioned is 5 years. The interest rate is 8% per annum. And then in year 4 and year 5, it increases by 25 basis points to 8.25 in year 4 and 8.5 in year 5. Minimum investment is $50,000. The tax I've covered, and of course that security through the pledge of equity of the WF LLC entity assets, those land assets, the title ownership of those assets, which is held within this structure. So the allocation of the loan, as I say, is on a 40-60 basis between our Walton Land investment structure and our Builder Land Finance structure. They each offer slightly different nuances and benefits. which I'll go into in a bit more detail in a second. But simply put, on the Walton Land investment side, there is a predetermined agreement in place with a home builder. That may be D.R. Horton, but equally it may be one of those other top home builders that we've dealt with. That is through a letter of intent, which is signed with them at the time of acquisition of the land asset. The borrower holds title to those assets, so it's truly asset backed, and that ownership is on an all cash basis. So there's no kind of debt, no liens against the property. It's clean and clear title. We do, of course, go through a stringent due diligence process on each and every asset that we acquire. I'll show you an example of one of those in just a little while. And of course, this is all about adding value through the entitlement process, working with the home builders and, of course, our external engineering consultants to secure the entitlements on that land. On the Build Land Finance side, I'll very briefly glance over this because I'm going to go into it in a bit more detail in a second, but that is a specific and exclusive arrangement with D.R. Horton. Not only is it secured by title ownership, but once D.R. Horton exercise the option on that land, then that title ownership is replaced by a corporate covenant, and that again is why their investment grade credit rating and that counterparty risk is critical to this model. Also, they are paying on that model 15% premium to Walton for holding that land off their balance sheet. And of course, that very comfortably allows us to pay down that 8% to investors through this program. There is also an outside date for every asset that is acquired through the Build Land Finance program, which is 5 years. And of course, there is the capital investment made by Horton prior to the acquisition of the land itself, but of course then right the way through the holding period of that land. They are investing into it all the way through the process. So the Build Land Finance program, as I say, is exclusive arrangement with D.R. Horton. Once again, just giving some of those high-level details, which demonstrates their size and strength. We're very comfortable with dealing with them, and we've got a very, very strong relationship with them, which has been forged over many, many years. But the basic terms of Build Land Finance, and really how this comes about, is where D.R. Horton are bringing us short-term land assets that they're looking to develop within the next 24 months. And so on that basis, once we've conducted our due diligence, the prerequisite of that program is the land must be fully entitled. So there is no zoning or entitlement risk on it whatsoever. And that's a critical component of this model. Once we give the green light, then D.R. Horton puts 15% hard deposit down, which is non-refundable. Walton puts up 85%, which of course is through this program. And D.R. Horton then has 24 months within which to exercise the option on that land to commence development. At that point, because we hold title on the asset, we will transfer the title to them. And in its place, we will receive a corporate covenant from D.R. Horton, which is their corporate obligation to make any and all interest payments outstanding and principal payments, of course, as well. They continue to pay us the 15% per annum right the way through, which is paid quarterly. And the principal repayment is made as they actually start to build and sell the home. So pro rata out of every home closing through escrow, that principal repayment comes back to Walton, and that is then paid down to our investors, to our lenders through this program. We're not holding on to any principal repayments whatsoever. And as you can see there is that there's an outside repayment date on every single asset, which, as I say, is that 5-year mark. You may ask the question, well, what happens if D.R. Horton don't exercise the option? Well, number one, they forfeit their 15% that they've put down as a hard deposit on the asset. Number two, they must hand over all legal and engineering work on the asset because we hold title. And of course, we can then go and either retrade the deal or we can do a number of different things, which could involve negotiating with them, selling the asset, retrading it with another home builder. Ultimately, the land is fully entitled, so it's valuable in the market. Now, what we also did is when we launched this program, we went out to the market and we raised institutional capital. So we actually secured a $100 million facility through Fortress Investments. Fortress has since been had a controlling stake acquired by Mubadala from the Middle East, of course, sovereign wealth funds. So that becomes quite an interesting play, and again, regional relevance. But this was a $100 million facility, which allowed us to build a track record into the Builder Land Finance program very, very quickly. What's interesting here is that every single one of those assets which that was allocated into have now had their option exercised by D.R. Horton, and we've actually now gone out and we've refinanced this with a group out of Chicago at a lower rate, a more competitive rate. But we actually ended up placing $122 million through that Fortress facility into this program. So that gives you perhaps some comfort that there is a de facto institutional endorsement into this Builder Land Finance program.
Yeah, definitely. That's really important, Tim, because whenever people are looking to invest money, it is crucial to see how not just track record in terms of longevity, but track record in terms of institutional involvement is huge, because as you well know, no one is going to put $100 million into anything without knowing inside out, upside down, back to front, exactly how that works, what it is, and being very confident to do it. So from a retail investor perspective, that's absolutely huge, because how many investments can you go into where you can say, institutions have thrown $100 million into it, or one institution anyway, but that's a really big plus, I think, for the offering to be able to say that.
Yeah, absolutely. And what's also interesting, Vinny, and I'm going to have to be a little bit careful here because this is on record. But since we went out and refinanced that with another group, and effectively, bought or took Fortress out of the equation, which means they've had all of their money back. That's full cycle. That's fantastic. But what we've also done is we've got another, the other institution has come in for about $400 million, which they want to deploy into this program as well. We've subsequently had another one out of New York, which is a large hedge fund. They shall remain nameless at this moment in time.
No, name them, Tim. Name them. It's much more fun that way.
Not until it's signed, sealed, and delivered. But they've signed a term sheet for another $450 million. And we've had another signed term sheet from a large PE firm for another $100 million. So all told, about $950 million of institutional capital coming into this program, still to be finalized, but looking very, very strong. And that's going to be breaking news when it's completed. So again, further endorsement of this program.
Yeah, I'd love to see that once it's complete and it's ready to be press released, to get details of that. That'd be really interesting to see.
Yeah, absolutely, and we'll make sure that is circulated just as soon as it's out for sure. And the reason why it is generating that kind of interest is really what you see in front of you here. This is now a $206 million track record. In fact, it's a little bit more than that, about $212 million now. And you can see that all of these individual project assets, the duration ranges from about 1.7 years up to the full 5 years, I believe, if you look down here. But also, a number of these have gone full cycle. A number of them are actually in the principal repayment stage with home sales activity, and all of the others are under development, which means that all of these have had their option exercised by Horton. They haven't dropped one deal, and your average duration there around 3.5 years. So, this is going very, very well. It's a very, very strong part of our business, and it's going to grow continuously over the next number of years. And just to give you a couple of case studies, this is a project which was the first one there in the track record. It was a small project, 22 acre size for 138 single family lots. The funding amount was just a little under $5.5 million. And you can see the project timeline, from the land acquisition to the transfer of title, land development to home sales. It was completed in 1.7 years. So this really, just gives you an understanding of the kind of assets that Horton are bringing to us in this program. It really is to meet their short-term development pipeline. This is another one, Agate War Bonnet. Again, this is about a $10.5 million funding. But once again, 2.8 years, done, dusted, fully built out, gone full cycle. And again, proof of concept. Very much at the forefront. And again, Elena Trails over in Phoenix, about a $7.3 million funding. And again, 4.5 million, so a little bit longer. This is ongoing. But once again, very much giving you an understanding of the kind of projects that are being brought to us in this Builder Land Finance program. So coming back to that loan security, we're just going to have a look at the Walton Land Investment side, which of course 40% of the loan is allocated into. And this just gives you an example of a kind of project that would be allocated on that basis. A direct land holding with direct title deed, different home builders involved. This is an asset, about an $8.4 million syndication. Actually, although the target home builder was D.R. Horton, it's actually under agreement, under a letter of intent with Eisenhower Property Group. And you can see that this is a 3 to 5 year projected hold with a 1.6 to 1.8 multiple. This is over in Pensacola in the Florida market. And what's really interesting here is, again, this is not frontier acquisition. This is an acquisition in an existing master plan which is already under development. You can see here the grading, the rough grading is going on. This is where the infrastructure development will take place. And this is actually being developed out currently by holiday builders D.R. Horton and Lennar. So this is already underway, and in fact, you can see the Jubilee asset over here in the background. So it's not a great stretch of the imagination to understand, how this is overall phase by phase going to develop out in this master plan. You can see where Jubilee sits here, just on the western side. This is this section under here, which is under development right now, and of course you can see these other areas within the same master plan and how it sits within existing development in this particular sub-market as well. Of course, as you would expect, we conduct significant due diligence on these assets, and that covers everything from environmental site assessments to engineering reports, market studies, geotech, and title inspection. And the way that these assets, these Walton Land investments, are going to generate cash flow back into the loan structure is through a phased exit. So you can see here that on this particular case, looks like a 3-phased exit. This is projected, of course, it could vary, but you're looking at 3 phases, 2028, 2029, and 2030, and that generating the cash flows. So based on an $8.45 million offering, this is going to generate, it's projected around $15.6 million coming back in based on that, which gives an ROI of about 1.76x. So again, you can see how we're very comfortable being able to generate this fixed income return through a combination of the Builder Land Finance program with Horton and, of course, the sale of these Walton Land investment assets to other home builders. And of course, through Walton Land Finance, as I've mentioned, we're now on our 11th series. You can see here, this covers the series from 1 to 7. And not only does it show you the amount of capital raised, which, as I say, was around $10 million for each series up until the series 9, which is just fully subscribed. You can also see the number of land assets that have been acquired and the geographical breakdown of those. So again, what you're not doing here is you're not betting on one particular sub-market in the US. You're taking a view and taking a diverse allocation across the growth markets within the US, different housing markets, different home builders, different sub-markets across the US. And I think that diversification angle is critical to the success of course, of any portfolio. And then in terms of reporting, there are quarterly Walton Land Finance fact sheets and reports. And of course, what this demonstrates once again is the truly asset-backed nature of these allocations or these loan series. Each one identifies the proportionate allocation across the respective assets, wherever they're located in the US, and across both Walton Land Investment and Builder Land Finance structures. So each of those can be identified depending on the series. So again, it's a really tangible in the sense of knowing that each Walton Land Finance series is holding proportionate title ownership across the assets within it, and that's, I think, a really important aspect of the strength of this proposition. One of the things which is perhaps a little unusual is that we also have Sharia certification for this Walton Land Finance structure. That is through a group out of Malaysia and Kuwait, in fact, called Masref. We've done some extensive work with them, and they provide us with the certification confirming that through a Murabaha financing structure, we can offer a Sharia version of this as well, which of course is counterintuitive given that it's a loan structure, but the way that is structured means that we are able to meet that requirement, and of course we carry Masref's endorsement there. So there is a $15 charge for that facility. That's 15, so not a lot to ask for that mechanism. And then finally, really just to give you an understanding of how this Walton Land Finance structure works based on a $100,000 investment, as you can see here, just an example. I think one of the key features which I haven't talked about in depth is the nature of the principal repayment aspect of this loan structure. Typically, for a kind of a loan structure, you would see that principal being held until maturity and only then distributed back to lenders. Instead, what we see is through the phased sale of the homes under the Builder Land Finance program, and of course the phased sale of the land assets in the Walton Land Investment structure. What you're actually seeing is or expecting is principal repayment during the term. So if we look at this, you can see the 8% per annum interest being paid, which is being distributed quarterly, April, July, October, and January each year. But then as we come down here, we expect that from around year 2.5, year 3 onwards, you'll start to see that principal repayment being made as well. So as that principal repayment comes in, and of course this is just an illustration, the reality of the way that would come in is you'd start to see it coming in out of every quarterly payment. But just for illustration here, we're assuming $20,000 principal is repaid in 2028. And that, of course, takes that outstanding principal to $80,000. Your 8.25% in year 4 is then calculated on the principal balance outstanding, which means you can see the interest rate being paid out here. And then once again in 2029, a principal repayment is being made under this illustration, which takes that principal outstanding down to $60,000. And then, of course, the final payment coming in here in 2030. The reality of this is the way those principal repayments is actually going to be made once they start is a much more regular basis than what's being illustrated here. But just for simplicity, this just gives you an understanding of the way that it could work and how that impacts the outstanding principal and of course those interest payments accordingly. But of course that final part here being that in that final year you're looking at an 8.5% as that interest rate has ticked up in each of those year 4 and year 5 extensions.
Got it.
So overall, looking at about a 1.38 multiple and a $37,675 dollar return on this $100,000 investment example.
And what have you found as being a typical client for this type of product, Tim? I've got something in mind, but I don't want to put words in your mouth. How have you seen it being received by what sort of demographic of client, if you like?
Yeah, what we've really seen, and that's of course largely driven by the advisor that's talking about it at the time. But certainly one of the things that I can tell you is that, anecdotally, once clients receive those first couple of coupon payments, they're perhaps testing the water a little bit to start with, and of course once they get comfortable receiving those quarterly coupons, the proof of concept is there and is in place, and of course they then come in a sort of generally much bigger way. But we're certainly seeing clients who are allocating anywhere from sort of $100,000 to $250,000 into this program quite comfortably. Of course, it's a percentage of a client's overall portfolio, and we're not generally privy to that. That of course is part of your role.
Okay, fair enough. Yeah, I think this is ideal as a good percentage of a portfolio that's getting towards retirement and looking for steady, predictable returns as part of a bigger portfolio. But this is ideal, really, just in terms of the track record, the history, the institutional interest, and the predictability. I think it's exactly what a lot of people are looking for. Getting away from the stock market, that volatility, and not kind of sleep at night a bit sort of safer and sounder in that respect. This is definitely the sort of type of interest I've seen for this type of product anyway.
Yeah, absolutely. I think the other thing as well, and perhaps a point I should have made earlier, but the US real estate market is, let's be honest, it's almost too big to ignore. The biggest challenge for investors in this part of the world, of course, is how to access it in a relatively hands-free manner. Should they have exposure to US real estate? Well, one could argue, yeah, absolutely. But it's just about how, and people don't want to necessarily be involved in bricks and mortar, physically owning property in the US, the tax implications that of course brings, the fact it's an awfully long way away, and how do they actually physically manage it from a tenant's perspective, or replacement of white goods and all of those kind of aspects. But again, it's too big to ignore. It's still the largest economy in the world. And it's just a question of how to access it. And I think what this provides is a really good kind of risk-adjusted return opportunity in US dollars in the US real estate market, and again with fantastic counterparty risk involved as well.
Yeah, I totally agree. I think everyone everyone wants to have some exposure to property and real estate, but of course, the management of that is a significantly sort of underappreciated thing. Now and again, like you say, getting a tenant in, collecting the rent, maintenance, repairs, all of that sort of stuff, taxation, which you don't have to worry about with this. I mean, even if you had direct property in the US and you're renting it out, the yield you'd be getting maybe 4-5% maybe, and then that would be taxable. So having this at 8%. Although there's no sort of capital appreciation, but having that flow with the flexibility of not having to worry about selling a property, not having to worry about a tenant, not having to worry about furnishing it, it's got to be a very attractive option, I think, for a lot of people.
Yeah, absolutely. And again, one of the big factors here is that tax exemption. It really does sort of stand out as a real opportunity, and I think for a lot of people over in this part of the world as well, a real benefit, because let's be honest, most people don't want to deal with the sort of the US tax net. Although, to be fair, in other structures that we provide, it does become a relatively simple and actually not so punitive element. But of course, if you can be in a structure which benefits from no kind of tax exposure, then all the better for it. And one of the things that's beneficial there is that it does open it up to corporate investors as well. So one of the things I think is always worth mentioning here is there are a lot of entrepreneurs in this part of the world, a lot of business owners, and of course probably a lot of those that have got substantial amount of retained earnings and capital perhaps sitting on deposit in their corporate accounts. They certainly don't want to put it at risk, but by the same token, is it really working for them? Well, this is perhaps something they could consider, because it does allow for corporate investors, because of that tax treatment, and so again, because of those those quarterly coupon payments, it may just be an attractive opportunity for business owners, entrepreneurs to perhaps deploy some of their corporate capital that's sat there that they don't necessarily need over the shorter term, and actually put it to work in an effective manner. So that's again perhaps a different angle to think about, rather than just perhaps an individual as well.
Yeah, interesting. Okay, I think we'll probably wrap up there, Tim. Leave it there for today, unless there's anything that's super urgent you'd like to squeeze in at the end there.
No, I think that's it. The only other thing I would say is that in terms of ongoing communication, we do actually operate also our own client application and web portal login, and that does mean that your clients, Vinny, will have fingertip access to be able to see their statements, and of course receive notifications in terms of quarterly updates and income payments as well. So just a nice additional feature that means that there's fingertip access for clients, and of course you've got your own business partner login there as well, so you can see all of your clients in one place.
Perfect. Sounds good. Right, I think we will wrap it up there, Tim. And for everyone listening, thank you for joining. If anyone is watching this on YouTube and you have any follow-up comments or questions, please do pop them into the comment section below this video. I will get back to everyone who would like to make a comment or a question. Happy to do that. And if you'd like to reach out directly for a meeting or a chat about this or anything else, of course, obviously do feel free to do so. And when there are updates to this topic or any other, we will do subsequent presentations and chats on that. I think obviously with everything in the industry, there are developments and macro sort of developments in the economy that might impact this. So keep an eye out for any future presentations. But for now, thank you very much for joining, and I hope everyone found that interesting. Cheers, Tim.
Thanks, Vinny. All the best. Thanks, everybody.